In the quiet chambers of our financial aspirations, a whisper often arises: can our investments not only grow but also do good? This question, profound and deeply personal, has led many to the world of ESG investing, seeking a path where profit and purpose intertwine. It is a compelling vision, one that speaks to our deepest desires for a more conscious and sustainable future. Yet, what if the narrative we've embraced, the very promise of doing good while doing well, holds layers we haven't yet peeled back? What if, much like Benjamin Graham taught us to look past fleeting market sentiment to the bedrock of intrinsic value, we need to apply the same rigorous skepticism to the shiny surface of ESG. The market, after all, is a complex tapestry, and not every thread is what it appears to be. It can feel unsettling, even disloyal, to question something so widely championed as socially responsible. The heart yearns for alignment, for investments that reflect our deepest values, offering a sense of peace amidst the market's turbulence. Yet, the mind, the investor's sharpest tool, demands clarity, demanding to know what's really driving the market beyond the headlines and the well-intentioned pronouncements. This internal tension, this cognitive dissonance, is a familiar companion on any journey toward genuine understanding. Here, we do not shy away from discomfort. We embrace it, for it is often in discomfort that truth begins to reveal itself, much like a hidden spring emerging from dry earth. Our journey together will be one of data-driven deconstruction, a quiet pilgrimage through the often murky waters of ESG, seeking the genuine underlying mechanisms, hidden truths, and effective strategies. We will move beyond the superficial analysis, beyond the market noise, and into the core of what truly creates sustainable wealth. We will acknowledge the sincere aspirations and potential benefits woven into the fabric of ESG, for they are real and speak to a collective yearning. But we will also, with gentle precision, unravel the common misconceptions, the marketing narratives, and the superficial analysis that can obscure its true financial implications. Is your diversified portfolio truly diversified, or is its ESG label a comfortable blanket over complexities we must confront? We are here to challenge the consensus, to find your edge. This isn't about dismissing noble intentions or undermining the desire for ethical investing. It's about empowering you, the ambitious professional, the discerning investor, to make truly informed decisions, to move beyond the emotional pull and anchor your wealth strategy in the bedrock of understanding. We are uncovering the hidden truths behind wealth accumulation, even within this evolving landscape. Don't just invest, understand the why behind every decision. A quiet distress often settles upon the ambitious investor when navigating the opaque world of ESG ratings. There's a gnawing inadequacy, a fear of missing the mark, because what truly defines good in these metrics often feels subjective, disconnected from both genuine impact and consistent financial performance. This uncertainty can erode trust, leaving us questioning our own judgment. Many believe ESG scores are a direct measure of ethical performance or even a guarantee of superior returns. This is a common myth, a form of confirmation bias that masks inadequate due diligence. We must dissect how these scores are compiled, revealing their inherent biases, lack of standardization, and the fertile ground they offer for greenwashing. It's crucial to understand that a high score doesn't always reflect a company's true ethical stance or its real-world impact. The expectation that high ESG ratings equate to genuine environmental or social betterment is often shattered. Companies lauded for their ESG policies can still have significant negative externalities hidden beneath the surface. Paradoxically, some science stocks, shunned by ESG funds, can sometimes outperform due to lower capital costs, challenging the comforting narrative that good always pays off in direct financial terms. It forces us to ask, is our diversified portfolio truly diversified, or is its ESG label a comfortable blanket over complexities we must confront? To discern genuine corporate responsibility from mere ESG theatre, we can employ a three-step strategic finance technique. First, deconstruct the company's core business model for its inherent sustainability risks, looking beyond glossy reports. Second, analyze capital allocation. How much is truly invested in ESG initiatives versus how much is spent on marketing? Third, evaluate the real-world, quantifiable impact metrics, moving past self-reported data. This framework offers a clear, actionable path. Finally, we must acknowledge the subtle pull of dopamine, the feel-good factor of investing ethically. This short-term emotional reward, while appealing, can inadvertently hinder empowered, data-driven decision-making. Aligning with a popular narrative can overshadow the long-term discipline required for rigorous fundamental analysis. Much like chasing a fleeting market trend over intrinsic value, don't just invest. Understand the why behind every decision. The ambitious investor, seeking both purpose and profit, might find a silent unease creeping in when considering the true impact of ESG filters on their portfolio. A fear of financial loss and investment inadequacy arises not from a lack of diligence, but from the opaque ways ESG can inadvertently concentrate risk, limiting the very diversification we seek. We might believe our ourselves protected, yet unwittingly stand vulnerable to sector-specific downturns we thought we had sidestepped. There's a common distortion about diversification within ESG portfolios. The comforting belief is that by screening for good companies, we inherently reduce risk. Yet, the very act of restricting our investment universe based on ESG criteria can lead to unintended sector concentration, perhaps a heavy leaning into technology or consumer discretionary, potentially increasing systemic risk. This narrowing of the field can also limit our exposure to genuinely undervalued opportunities that fall outside the ESG lens, creating a different kind of blindness. The expectation that ESG integration always leads to better risk-adjusted returns can be shattered. While noble in intent, it sometimes introduces new, less obvious risks or, in certain periods, underperforms traditional benchmarks. Historical data can show instances where sector biases or the deliberate divestment from profitable industries led to significant opportunity costs and diminished returns. It's a quiet truth. The pursuit of one form of good can sometimes come with an unseen cost to another. To truly understand these unseen costs, we can employ a practical risk management method, the ESG portfolio stress test. Imagine simulating market downturns and sharp sector rotations, applying these forces to an ESG-filtered portfolio and then to a broad market index. This allows us to identify potential vulnerabilities, to quantify the cost of conscience, and to make truly informed trade-offs between our values and traditional financial metrics. It's about seeing the full landscape, not just the painted path. The emotional consequence of dissecting ESG with a wounded financial confidence can be profound. Realizing that an ethical investment might carry hidden financial risks can shake our belief in our own informed decisions. Yet, mastering this rigorous analysis is not a betrayal of our values. It is an act of reclaiming autonomy. It's akin to the value investor who, through diligent work, unearths a mispriced asset that others overlook, finding strength in their independent judgment. This analytical journey ultimately fortifies, rather than diminishes, our financial wisdom. There is a deep philosophical wound that can arise when we observe greenwashing, superficial efforts rewarded, while genuine, sustainable innovation struggles for recognition. It feels fundamentally unfair, challenging our belief in market logic. As ambitious investors, we yearn to understand how to truly identify companies building durable wealth, not just through fleeting trends, but through authentic, deeply integrated sustainability. A common myth whispers that sustainable companies automatically possess robust economic moats, but simply having an ESG label or an eco-friendly product does not guarantee a long-term competitive advantage. Many ESG plays, while well-intentioned, can be fads, much like any other market excitement. True moats, as we know, are built on more enduring foundations, formidable cost advantages, powerful network effects, or unique intangible assets that ESG alone does not confer. We must look beyond the label, into the very sinews of the business. The counterintuitive truth is that true sustainable competitive advantages often emerge not from marketing, but from deeply integrated operational efficiencies and innovative technologies. An economic moat derived from sustainability is about superior unit economics, about a profound resource efficiency that reduces costs, or about a foresight into regulatory shifts that positions a company years ahead of its peers. It's about substance, not just public perception. To discern these genuine sustainable moats, we can apply a powerful value investing technique. First, analyze a company's capital allocation. How much is truly dedicated to R&D in green technologies, rather than just public relations? Second, assess its supply chain resilience to emerging climate risks, understanding its vulnerabilities and strengths. Third, evaluate its long-term regulatory foresight, recognizing which companies are preparing for the future, not just reacting to the present. This moves us beyond superficial ESG metrics to identify businesses with durable competitive advantages aligned with a truly sustainable future. The story of John Bogle, the pioneer of index investing, offers a quiet wisdom here. Bogle often warned against the pitfalls of chasing fads, and while ESG itself is not inherently a fad, the approach to ESG investing can easily fall into that same trap. Chasing popular narratives rather than digging into fundamental value echoes Bogle's critique of active management's often overhyped promises. It reminds us, don't just invest, understand the why behind every decision. Challenge the consensus. Find your edge. The sheer volume of ESG information, often without clear synthesis, can overwhelm even the most diligent investor. This information overload, combined with the powerful emotional pull of doing good, frequently leads to analysis paralysis or, conversely, impulsive decisions driven by moral sentiment rather than sound financial logic. It's a challenging internal landscape where the heart's desire for impact can sometimes overshadow the mind's need for data. A pervasive confirmation bias often masquerades as conviction, hiding a dangerous tendency to ignore contradictory evidence. Investors, deeply committed to aligning their portfolios with their values, might selectively notice data that supports their ESG choices, while subtly dismissing evidence of underperformance or hidden risks. This isn't a flaw in character, but a deeply ingrained human tendency, one that can subtly steer us away from truly informed decisions. The expectation that ethical investing always brings both financial and emotional rewards can, paradoxically, lead to suboptimal portfolio construction. The emotional satisfaction of doing good can unconsciously override critical financial analysis. We see how cognitive biases like the affect heuristic and moral licensing can lead investors to accept lower returns or even higher risks for ESG funds, simply because the investment feels right. This is a subtle trap where our best intentions can inadvertently compromise our financial well-being. To counteract these powerful biases, we can adopt a mental healing model inspired by Daniel Kahneman's asterisk thinking, fast and slow asterisk. Applying system to thinking to ESG. This means developing a disciplined checklist that forces a dispassionate, data-driven review of every ESG investment. It separates emotional appeal from cold financial logic, requiring rigorous scenario analysis for potential negative outcomes. It's an intentional practice of stepping back, breathing, and letting the data speak. Society, in its well-meaning push for ESG, has sometimes distorted the image of the independent, data-driven investor. A moral imperative has been subtly woven into the fabric of investing, inadvertently pressuring individuals into choices that might be less optimal financially. It can make it feel irresponsible to prioritize pure financial returns. But here, we empower you to reclaim your critical analysis, to remember that true responsibility lies in understanding all the truths, not just the comfortable ones. Challenge the consensus. Find your edge. A deep frustration often arises from incomplete or superficial financial education about ESG. It leaves investors feeling trapped, believing they must choose between their deeply held values and their crucial financial goals. This is a profound dilemma, a quiet ache, where the heart and the ledger seem to pull in opposite directions. But the truth is, you do not have to compromise. There is a path to harmonize both. A common distortion whispers that ESG investing is the only way to integrate your values into your portfolio. We must gently deconstruct this. The reality is far richer and more nuanced. Active ownership, direct impact investing, and even traditional value investing in companies with genuinely strong governance can align beautifully with personal ethics, often yielding superior financial outcomes. It's about understanding the full spectrum of possibilities, not just the most advertised one. The counterintuitive truth is that building a truly values-aligned portfolio demands more than simply buying an ESG-labeled fund. It requires deeper, individual research, a quiet introspection to define your own ethical priorities, and sometimes a courageous, contrarian stance against popular ESG narratives. This diligent work allows you to uncover genuinely impactful and undervalued opportunities, those hidden gems that resonate with your inner compass. To navigate this with clarity, employ a three-step strategic portfolio construction technique. First, define your non-negotiable ethical red lines, what you absolutely will not invest in. Second, identify sectors or companies with genuine, verifiable positive impact potential, looking far beyond generic ESG scores. Third, and critically, integrate rigorous fundamental valuation to ensure these choices also meet your financial return hurdles. This empowers truly informed decision-making, weaving your values into the very fabric of your wealth. The fatal mistake for those seeking actionable, data-backed financial strategies is to rely on superficial ESG labels without understanding the underlying financial and ethical mechanisms. This is like building a financial forecast written in sand on a windy beach. It looks solid for a moment, but offers no enduring foundation. Our aim is to provide the deep, foundational knowledge to build a portfolio that stands firm, reflecting both your deepest values and your unwavering pursuit of sustainable wealth. We are uncovering the hidden truths behind wealth accumulation. We have journeyed together through the intricate landscape of ESG, peeling back layers of narrative to uncover the underlying mechanisms. The core insight we carry forward is this: ESG is a complex tool, not an infallible dogma. True responsible investing, much like the wisdom Warren Buffett imparts about independent thought, demands critical thinking, rigorous data-driven analysis, and a clear-eyed understanding of its limitations. It invites us to look beyond the surface, to value what we truly understand, not just what is widely acclaimed. Our purpose here has never been to dismiss the earnest aspirations behind ESG. Rather, it is to approach it with the same unwavering rigor and healthy skepticism we apply to any investment opportunity. We seek to distinguish genuine impact and sound financials from the alluring whispers of marketing narratives. It's about cultivating a discerning eye, one that sees both the potential for good and the potential for misdirection, allowing us to walk a path of true clarity clarity. This journey empowers you to move beyond a passive acceptance of ESG labels. It calls you to become an active, informed decision maker, capable of constructing a portfolio that truly reflects both your deepest financial aspirations and your most cherished values. It is a reclaiming of autonomy, a quiet revolution in how you engage with your capital. No longer will you simply follow, you will lead, guided by your own cultivated wisdom. Now, the invitation is extended to you. Take these analytical frameworks, these insights into behavioral biases and genuine moats, and apply them. Critically reevaluate your existing portfolio. Examine future investment opportunities with fresh eyes, asking the hard questions, seeking the hidden truths. This practice is not merely about financial gain. It is about fostering a deeper sense of financial mastery, a profound confidence that comes from knowing you are making truly informed decisions, aligned with both your intellect and your conscience. In this ongoing quest for sustainable wealth, where do you find the bedrock of your conviction?